good evening. You're watching The Money Show on ET now. This is your daily dose of personal finance news and opinions. Let's tell you what we have lined up today on the show. It is the 28th of September. The 30th of September, that's precisely just 2 days from now, will be the last date for you to file your income tax return, not for March 2020, but for March 2019. So if for some reason, and by the way, the deadline for the same was already August 2019, but if for some reason you had planned on filing a belated return or a delayed return, which again may have further got delayed because of COVID-19, the government has given you a further leeway till the 30th of September. Ordinarily, this would have been the 31st of March 2020, but they've extended it by 6 months given the problematic situation that COVID has sort of, created. So 30th September is the last date for that return. How can you file it? What will be the section under which you will file your return? What will be the repercussions if you don't file your return is what we'll be discussing, along with, of course, that all important clarification that the government released, rather the Income Tax Department released. In FY20, there is going to be some changes in the way you will file your return, especially if you have sold shares or mutual funds during financial year 2020. What are these changes? Who is it applicable to? All of that will be discussed today. I have with me Mayur Shah of EY India. Later on the show, in our Meet Your Fund Manager segment, we'll be talking about a new fund offering. That's the ICICI Prudential ESG Fund. Environmental, social and governance norms. That's what the fund will be looking at. Will be judging companies based on the parameters of to decide whether the fund will invest in these companies or not. So to know more about this fund as well as whether you should be subscribing to this NFO, stay tuned. We'll be bringing on board the fund manager of this brand new NFO itself, Mr. Mrinal Singh of ICICI Prudential. So it's an action-packed day right here on The Money Show. Don't forget, you can write in your queries to us with respect to taxation on The Money Show at etnow.tv, and Mr. Mayur Shah will get them answered. So first up, let's introduce him on the show. As you all know, he is the partner and people advisory services with Ernst & Young LLP. Mayur, many thanks for joining us today on The Money Show. It's a pleasure having you back with us. So to start with, let's get, the news that was taking the rounds in the last couple of days and over the weekend out of the way. There's the IT department clarification as well that came, because when initially, there was the rounds that, okay, you're going to have to report every sale of share, to the income tax return. I'm sure a lot of day traders and, short-term security holders were left scratching their heads. How on earth are we going to do this? But of course, the department was pretty prompt in releasing a clarification saying that, look, this is not applicable for day traders whose largely would be categorized as, business income or speculative income. It's more for long-term investors. If you held a listed share of, let's say, Tata Steel, HDFC Bank, TCS, or whatever it is for more than 3 years, then it will be called, 1 year, then it will be called as long-term capital gain. So, Mayur, how is this different? Because as far as I remember seeing this provision even in my FY19 return, where I could report each and every share that I have sold during the previous year in my return. So what is different in FY20?
So you are absolutely right. There is nothing so different about what was there in FY19 vis-a-vis FY20. I think, the point which has been made herein is that earlier it was optional for anyone to, in case of they have a long-term capital gain, to report or not to report script-wise gain or a loss suffered by the person. Now in FY20, the way it has been made, it is mandatory for each one of us to, incorporate the details of purchase and sale. And capital gains or loss is being calculated by the system itself, and basis which the tax liability and computation does get generated within the system. So the change is only that now earlier offline working was to be done. Now it can be done online as well. So this is the change. And in past as well as now also, and as you rightly pointed out that over the weekend, this has been clarified by the income tax authority that script-wise detail need not be given for the persons who are offering that income thereon on sale or purchase of shares as business income, or that has been offered as short-term capital gain. Then there is no requirement of putting that thing in. And the reason why they are doing it is because there are different tax rate needs to be applied for long term in case you offer something, and that's the reason why they need script wise detail, that which script will be eligible for a reasonable rate, or so that whether it is 10% or not, or which is at the rate of 20%. So for that reason they need a bifurcation.
So I believe in a way, Mayur, maybe it's become a little easier as well for individual investors, because now instead of, before filing your return, you do all of those calculations on a piece of paper or on a spreadsheet, and then you put that bulk amount as, long-term capital gain or loss. Now you can just simply state each and every share that you have sold during the year in the ITR itself. Mayur, what will they essentially calculate? Will I have to simply punch in my date of purchase, date of sale? What will I have to essentially punch in, and what will be automatically calculated? I just want to understand that.
To punch in is the details of sales proceed, what has been received in connection with that, and the date of purchase, quantity purchase, and value which or the cost of acquisition needs to be fed in. Basis which the calculations will happen automatically in terms of what is a long-term capital gain or a loss, and for which period it is. Accordingly, whether advance tax paid, not paid, and all that thing will get calculated automatically.
Mayur, what happens in case of the whole grandfathering bit? Just to refresh the memory of our viewers, this would be applicable for those people who have purchased shares before the 31st of Jan 2018. That's basically the day before Mr. Arun Jaitley in his budget said that, look, now I am going to tax 10% for long-term capital gain above 1 lakh rupees. So it was just before that date. If you have purchased shares and if you have held them for the long term, that means again more than 1 year, then you would be taxed long-term capital gain. So it's not easy, to calculate the cost of acquisition in that case, because you have to compare fair market value as on 31st Jan 2018 with the cost of acquisition, again compare it with the sales price as well. So it did involve a little bit of complexity. So does the income tax return sort of make it easy to do that as well? Or let's say if I am sitting down to file my return, I'll need all of that data with me.
You are absolutely right. Once you key in the data, which number to pick up, whether fair market value as on 31st Jan needs to be considered, or you need to consider the original cost of acquisition, all that will be done by the system, so that complexity is just being handled by the system. You have to just key in the data and it will show the result. What is the actual gain which is subject to tax and what is not subject to tax. So it bifurcates automatically in the system itself. So basically, once you punch in the data of cost of acquisition and 31st Jan, then automatically it will start calculating whether they should pick up the number as on 31st Jan or it should pick up the original cost. Let me give you an example that if fair market value is lower than the cost of acquisition, then they will consider cost of acquisition and calculate capital gain. But if fair market value is higher than the cost of acquisition, in that case, the system will consider only fair market value for calculating the capital gain, which is subject matter of taxation. It will also calculate the capital gain, which is not supposed to be taxed, and that will be reflected in the system itself.
So I think by the looks of it, whatever the department has now incorporated in the new return, that's from FY20 onwards, it's all in a quest to make your calculation of long-term capital gains simpler, because now the system itself will automatically calculate if it's a gain or a loss. And in case of, let's say, if you bought the shares prior to 31st Jan 2018, in such a scenario as well, you simply have to punch in your cost of acquisition, the date at which you bought it. And the minute the system recognizes that you have purchased this prior to 31st Jan 2018, then it will automatically pick up either the fair market value or the cost of acquisition, whichever is higher, because that's basically what the grandfathering clause means. And again, ladies and gentlemen, this is only if you of course sold the shares and realized the gain or loss, whatever it is, and if you held it for more than 1 year. Just to reiterate for our viewers, if you held it for less than 1 year, in which case it would be either a short-term capital gain or a loss, no need to report it on your income tax return. And of course, if you are a day trader, then as well you'll be considering it as your business income. So then as well, there's no need to give any such script-wise reporting. And even for all long-term capital LTCG assessees, this process is just to make your life simpler. So now when you will sit down, and I'm hoping you guys will sit in the next couple of weeks to file your income tax returns, because remember folks, the last date for that is 30th November. You'll probably need very few things, won't even perhaps need a calculator, because all of it will be calculated by the income tax form itself. Okay, well, this was topic 1. Now let's address the second topic, and that's with respect to filing your return for March 2019. This is the previous year. March 2020, the last date is the 30th of November, but for March 2019, by the way, you're already late. This will already be considered as a belated return, but you cannot go beyond September 2020. This is an extended date. So, Mayur, firstly, let's understand what would this return be called? Is it a belated return, a delayed return? And what would be the repercussions of going beyond even the 30th of September or not being able to file your FY19 return?
Yeah, so if any return which is being filed after now will be regarded as belated return, or if you have already filed the original return, then this will be considered as revised return. Now, assuming that the person is unable to file the return even by 30th September 20, in that case, the consequence is something like this, that any income which is escape taxation will be subject to interest and penalty. If any losses which are suffered, which has not been, which will not be allowed to be carried forward on a going forward basis. If there are any income tax refund due, and any interest which is payable by the department on that, for the delayed period, interest will be denied on the income tax refund. Secondly, if we file the refund now after the delayed return, in that case, that refund itself can be denied by the income tax authorities. Secondly, if any tax is payable and if it has not been paid, definitely it will be considered as concealment of income, and the consequences of penalties and other consequences will follow. If a person had any foreign income or foreign asset to be reported, and if that has not been reported within the due date, the tax authority may consider this as a concealment of foreign income and asset and may get covered under the Black Money Act, which can be a disaster for anyone who has foreign assets and not filed the return. Separately, income tax authority do get information about the income from various sources, from the banks, from the financial institutions, and so on and so forth. And therefore, they would immediately issue a notice, which is known as, notice under section 148, which is considered as concealment of income, not reporting income which is ought to have been reported. And therefore, again, the same consequences can follow. So it is advisable for all of us to file the return within this delayed period. If we don't file it, then there are severe consequences which anybody can face.
Okay. If you are due for a refund, you will not get that refund. Further, there will be penalties which will be imposed. The tax authorities may also consider it as concealment of income. That could come with added penalties. So it's always a good idea to file your return. And let me just tell this to our viewers, due to paucity of times, I would have loved to actually get in Mayur's opinion. But yeah, even if your income is less than 2.5 lakh rupees, which is the basic exemption limit, or even if it's zero, let's say for the year, still you must ensure that you file your income tax return. Make sure you check your form 26AS as well, because various banks and, various payers to you do deduct tax. So if, you are below the taxable threshold, then you deserve a refund of that. How will you get your refund? By filing your returns. So don't forget, you've just got the last 2 days left to file your returns. Get clicking. Everything is available online and you can file your return in just a couple of steps, thanks to the whole digitized mode and thanks to the Aadhaar linking with which the IT department has made the process so simple. Okay, let's very quickly take on board some questions and queries that we've received from our viewers. Our very first query has come in from Prasanna. He says that during FY20, and in brackets he notes, though it was the worst ever fall due to the pandemic, I had a huge loss. I'm assuming he's talking about shares. He wants to know about filing ITR 3 and he wants to know whether an audit is required or not. I think this is a very timely question as well. He further says that he is an employee for a private organization. He's got a short-term profit of 1.85 lakh. This is on equities, and he has a long-term loss of 24,000 rupees. Further, he says that from the futures market, he's got a turnover that's including loss and profit of 24.57 lakh, where his loss is 19. Gosh, I'm getting old. I think I need glasses. It's 19.4 lakh rupees and a profit of 5.2 lakh. So his net profit or loss is roughly about 14.1 lakh. So he wants to know now, does he need an audit because his futures has a loss of 14 lakhs and his overall turnover is 24.5 lakhs. That's basically summing the loss and profit which we have to do when we are calculating FNO, and he also has salary coming in. So first, is it ITR 3 that has to be filed within 30th of November in order to carry forward the loss, and whether of course he needs an audit. Also, he's asking about presumptive income as per section 44 AD. Is that something that can be done for FNO business? Mayur, lots of questions, but I think it's valuable for all of our viewers.
So, first, if this income is reported as business income, then certainly, he has to file ITR 3 form. And as you rightly pointed out, he has to do it by 30th of November. Because that's the timelines within which he has to file the return. And if he doesn't do so, then even if there are any losses, he will not be able to carry it forward, even if he files delayed or belated return. Now, the other thing is that, if turnover is below 1 CR and if he's not covered under presumptive taxation, in that situation, he does not need his accounts to be audited. However, if he is covered under presumptive taxation, in that situation, these accounts are required to be audited, assuming that other income is about 2.5 lakh, and therefore, he is going to file the return basis that. Now, whether he's, whether he will be covered under 44 AD or not depends upon various factors. But to the best of my, the best of the facts which has been given to us and to the knowledge, I don't think he will be covered under 44 AD. Therefore, he might not need his accounts to be audited.
All right. So he may not need to get his accounts audited. There's that 1 crore threshold as well that all of our viewers should keep note of. Okay, let's take on board our next query. We have Neha Agarwal saying that in FY19, I had 3 lakh rupees as short-term capital gain from investment in stocks, which I carried forward in ITR 2. Now, moving forward in FY20, Neha says she has 70,000 short-term capital gain, which she again carried forward in ITR 2, and 2.6 lakhs long-term capital gain, again using ITR 2. The question is how long I can forward my short-term and long-term capital losses in income tax return 2. She's also saying that now her net worth is only 2 lakh rupees. She's not salaried, and she's saying I am seriously thinking of starting intraday trading to be able to cover my losses in due time. Further, she says that if I change my status from investor to trader, then will I have to file ITR 3 in place of ITR 2? I think this is also a very interesting question, which is very relevant to the times that we are facing. And she's asking that even if, let's say, she switches, over to a new form, will all of her previous carried forward losses be shifted into the latest ITR 3, which, she'll be eligible, to file then later. And, I think, Mayur, this is very relevant. Unfortunately, because of the pandemic, a lot of people have lost their jobs. They're looking at the market. They're looking at, trading in the market. So I think this is a very relevant question to a lot of viewers. What would be the tax implications of the same? What happens if you change over your form, or does that really not matter because you are eligible to carry forward any LTCL or STCL regardless of what form you're using?
Yeah, there are two things. I think, what she's saying is that it's not a gain which he has earned, which is to be carried forward. I think the losses which are to be carried forward. And if any losses to be carried forward, see, the return is just a reflection, or ITR 1, 2, 3, 4, which is applicable to individuals, a reflection of which form needs to be filled up for what kind of income. That does not take away the right of it being carried forward. So, if the person has been filing ITR 2 and now because of change in the source of income, the person needs to file ITR 3, that does not take away the right of the taxpayer to losses to be carried forward. So the first answer is that even if changing the ITR form from 2 to 3, she would be allowed to set off the losses which has been suffered in past and can be carried forward in future as well. So there is no issue around it. She can carry forward. Such losses are to be carried forward up to 8 years from the year in which the loss is incurred. So if she has suffered a loss in 2018-19, she can carry it forward till 26-27. And if she has incurred losses in financial year 20, she'll be able to carry it forward till financial year 28. So the 8 years is the period till such time she can carry it forward. The other thing, she has asked a question that if she changes from investment to a business income, that is, doing an intraday trading, in that case, that will be considered as a business income. The most important aspect is that capital losses can be set off against only capital losses, and it cannot be set off against the business income. Now, in capital losses also, if there is a short-term loss, can be set off against short-term loss or long-term loss. But long-term losses cannot be set off against short-term losses. So one has to make sure that it is being carried forward in the same manner, and it can be set off only against that. Now, once it is being a capital loss, long-term or a short-term, it can be set off against any long-term capital gain or any short-term capital gain. So long-term losses can be set off against any long-term capital gain, need not be only arising on account of securities. Similarly, short-term capital loss can be set off against any short-term capital loss, and it need not be only set off against the security losses. Especially in this situation, when you are doing a business trading or an intraday trading, then such capital losses cannot be set off against the business income which is arising to NEHA. And therefore, that will still suffer a cost or tax cost on that.
Okay. I hope all of our viewers have, paid attention to what Mr. Mayur Shah has mentioned over there. Firstly, switching over really, even if let's say I move from ITR 2 to ITR 4 to ITR 3, the loss is still there on my books. So it's not like it's disappeared just because I've changed my form. So you are very well within your rights to carry forward that loss. Like Mr. Mayur Shah mentioned, it is for a period of 8 years. After that, the loss will sort of expire if you're not able to set it off. All right. Well, there you have it. That's everything to do with filing your income tax returns. The queries as well that we received were all with respect to the same. So, folks, like I mentioned, log on to www.incometaxindiaefiling.gov.in. pick the form that you're supposed to select, and I'm still talking about those people who've not filed their FY19 returns. It is absolutely imperative you do so. If you want to revise your return, that means if you've already filed your return, want to revise it, do it now. Or if you've not filed it at all, you can still file it, but it will be called as a belated return. You will probably be charged a little interest, but still just do it. Mayur Shah, many thanks for joining us today on ET Now and simplifying that whole bit with respect to reporting of scrip-wise share sales as well, particularly for those investors who've enjoyed long-term capital gain or suffered long-term capital loss during FY20. Ladies and gentlemen, this is a new disclosure, so make sure you give yourself a little time before you sit down to fill your FY20 return. But mind you, and I promise you that looking at it, it does look much more simpler compared to what it was before, because the system will calculate it all for you. Quick break right here on the show. When we return, we'll be joined by the fund manager of the brand new fund offering from ICICI Prudential, the ICICI approved ESG fund. Don't go anywhere.